G'day, Scuddy here. Markets may have just been hit with a case of double trouble. US economic exceptionalism still refuses to quit. The dollar's breaking higher and Japan's bond market is getting absolutely smoked. That's becoming a much tougher backdrop for risk assets to ignore. Just look at the US data pulse. Retail sales held up again in April, with the key control group rising 0.5%, above expectations. Input prices also surged 1.9% in April, the biggest increase in 4 years. Core input prices, excluding food and energy items, jumped 0.7%, reinforcing the message from inflation and producer price inflation data earlier in the week that inflationary pressures are broadening, not fading. That's now seen markets move to price the growing risk of a Fed rate hike this year, with 12 basis points of tightening now priced in, according to futures. That shift in rate expectations is now finally starting to show up in the price action in the US dollar. As you can see on the chart, the dollar index staged a bullish breakout from the downtrend it had been sitting in since late March on Thursday, reclaiming not only the 100 and 200-day moving averages, but also the 50-day moving average today. Traders will now be eyeing 99.31 resistance, with a break above that level suggesting that directional risks are not only shifting sideways, but potentially higher. At the same time, Japan's bond market is in full-blown bloodbath territory today, with long-end yields surging to fresh highs as markets scream for the Bank of Japan to get on with hiking rates. The latest slide coincides with more evidence of acute inflationary pressures buffeting the Japanese economy. Wholesale prices surged 2.3% in April, around triple expectations, pushing the annual increase to a multi-year high of 4.9%. Import prices soared 17.5% from a year earlier as higher energy costs and the weaker yen combined. For equities, this presents a problem that cannot be ignored forever. Rising global bond yields and a stronger dollar tighten financial conditions, creating headwinds for the global economy. Even the AI hyperscalers still rely on the real economy to eventually deliver enough earnings growth to justify their extremely lofty valuations. If liquidity tightens while growth expectations wobble, stock traders may need to start questioning how sustainable that momentum really is beyond the circular funding deals that are juicing them right now. Best of luck with your trading and have a great weekend.